Hi, my name is Jim and I was retired. This has been a very difficult year. High inflation, stocks and bonds are down, volatility is up. What is a retiree supposed to do? In this video, I'm going to review my portfolio by buckets to show you how I've been trying to manage this difficult environment. Chair Powell warned us a week ago we can expect a rough market until inflation is brought under control. He gave us the warning sign, caution, some pain ahead. I'm back with my solo cups to represent my portfolio with 3 time buckets and 3 tax buckets. To review, I divide my retirement portfolio into 3 time buckets. Bucket 1 has about 3 years worth of expenses in cash and cash and equivalents. Bucket 2 includes income producing assets for another 5 years worth of expenses. And then bucket 3 includes the longer term equity investments that I don't need to touch for another 9 years or more. And I have these in 3 tax buckets. There are the taxable accounts in my bank and brokerage accounts. This also includes my I bonds in my Treasury Direct brokerage account. It's a kind of a brokerage account. The tax-deferred bucket includes IRA and 401k assets. They are tax-deferred. Take money out of this bucket and you have to pay an income tax. Finally, the tax-free, which are the Roth assets. Take money out of this and there are no taxes. You pay your taxes before you put assets into tax-free. And then they grow and are withdrawn tax-free. Now, in prior videos, I've described the spreadsheet that I use to manage these 6 buckets, the 3 time buckets and the 3 tax buckets, to manage my asset allocation across time and across tax buckets. I do that with a spreadsheet where I download data from Quicken, and if you need a refresher on that, go see the list above. Now, earlier this year, I introduced you to the 3 time buckets by exploring what's in them. And I want to show you the progress that I've made from January through September 1st on altering my bucket allocations. Now, I can't tell you what direction the market's going to go in the near term, but this bucket strategy gives me some peace of mind to know that I have assets to cover expenses for 3 years or more. So that prevents me from having to sell assets in a down market. So let's take a look at how the buckets have changed from January till now. You can make modest moves to adjust your portfolio through rebalancing. And since January, I've been able to increase equity in buckets 2 and 3 to bring my overall portfolio pretty close to 50-50. Now, my goal longer term is to increase equity to 60%. I'm past the first 5 years of retirement, so I want to move to a 60-40 portfolio. But I'm doing that gradually rather than suddenly. Given the market circumstances, when is the right time to be at 60% equity? I've also managed to improve my overall expense ratio by replacing actively managed Vanguard funds, Wellington and Wellesley Income, that's VWINX for Wellesley Income and VWENX for Wellington, and I've replaced those with lower cost index funds. This helped me bring down my overall expense ratio to below 0.06%. Now, as I outlined a few weeks ago, I've also been able to tap a buffer asset, cash value life insurance, rather than taking an additional tax-deferred assets in a down market. So that buys me more time for those assets to recover. Let's take a look at where things stand 2/3 of the way through this horrible year. In January, I was down to about 46% equity overall because I had sold some assets to fill up bucket one and prepare for expenses for 2022. Bucket two was only about 16% equity, and bucket three was about 77% equity. Now, as of September 1st, bucket two is up to about 24% equity, and bucket three is up to 81% equity. So here's a pie chart of where my overall asset allocation was in January. Large cap stocks made up about 32%. International was 5%, small cap was another 5%, and REITs, real estate investment trust funds, were another 4%. Now, as you recall, I had a lot of cash, 11%, with another 4% in CDs, and domestic bonds made up 39%. But that domestic bonds was a broad category that included everything from I bonds to the bond portions of my balanced funds. And I've decided to take the domestic bond portfolio and divide it up into things that are safer than bonds, treasuries, TIPS, and I bonds, and the balance of that is now in domestic bonds. As you can see in the September pie chart, overall asset allocation is now 36% large cap, 4% international, 5% small cap, 4% of REITs, and then breaking down that fixed income slice of the pie, there's 12% in domestic bonds, there's 5% in I bonds, 20% in TIPS, 3% in treasury bills, another 3% in CDs, and 7% in cash. And taking a look at the time buckets, in January, bucket one was about 17% of my overall assets, bucket two was 29%, and bucket three was 54%. This also has, from my chart, a look at the asset allocation within each of those buckets, but I'll get into those in greater detail. Now in September, bucket one is about 18%, bucket two is about 30% of my assets, and 51% are in bucket three. And as you can see with the asset allocations, I've broken down that domestic bond into the more discrete pie slices. In the tax buckets, in January, about 10% of my assets were in Roth accounts, tax-free accounts. 20% was in taxable, and 70% was in tax-deferred accounts. And asset allocations looked like that. Again, domestic bond was not broken down yet. Now, tax-free is 12%, taxable is still about 20%, and tax-deferred is 68%. And here are my asset allocations of those three buckets. Now, this increase from 10% to 12% in tax-free accounts and assets is a result of an in-plan transfer in my 401k from my 401k to my Roth 401k. And because what's left in my 401k after the pension purchase option is mostly after tax and its growth, you're only taxed on the growth. And so I was able to transfer 15,000 roughly of 401k assets to Roth, but only pay taxes on about 5,000. So that was a smart move. Again, market didn't have anything to do with those kind of decisions that you can control. So let's take a closer look at what's in bucket one and how it's changed from January to September 1st. In January, bucket one included about 67% cash, 21% CDs, and 13% domestic bonds. And again, that was mostly I bonds in that first snapshot. Overall, 55% was in taxable accounts and 45% were in tax-deferred accounts. Now, in September, here's what's changed. Overall, on the taxable tax-deferred, you can see more of bucket 1 is tax-deferred. 43% is in taxable. And that is me positioning assets in tax-deferred to get ready for next year. So I've been able to increase that. On the asset allocation in bucket 1, you can see that 38% is in cash, 19% is in CDs, 19% is in treasury bills. And this is one of the ways I've put tax-deferred money aside for next year, short-term treasury bills. 14% are in tips, again, short-term tips, and 10% are in I bonds. And finally, let's take a look at bucket 2 and bucket 3 with these same pie charts. Bucket 2 assets are now 85% tax deferred, 15% taxable. And they include large cap stock, domestic bonds, I bonds, and tips, longer term tips funds usually. Now in my bucket 3 asset categories, the tax buckets include tax-free. 23% of bucket 3 are now my Roth assets. 62% are tax-deferred and 14% are taxable. And in the asset classes, large cap makes up 56% of the pie, 9% is international, 9% is small cap, 8% are REITs, and 19% are domestic bonds. I'll go into the changes that I've made in bucket 2 and bucket 3 in more detail next week. This is probably a good time to suggest that you hit the subscribe button below and the bell notification so you get a notification when next week's video comes out. I'll conclude with my standard warning. I am not a financial planner. I have no initials after my name. So take these as entertaining ideas from one educated consumer to another. Always do your own due diligence and seek out a professional if you need one. See you next week.